Hi guys, hope you are doing well. I am CA Chetan Kansara and I teach the subject of finance to the students of ACCA, CFA, CA and CS. I have an experience of more than 25 years in this particular subject. Today we are discussing a very important topic in the finance subject, and that is CAPM, Capital Asset Pricing Model. When we did cost of equity, when we started with cost of equity, that time we had discussed that there are two basically approaches. Okay, one is dividend valuation method. Dividend valuation method includes the company having growth, company not having growth, and the other is CAPM. So this is one of the method to calculate the cost of equity. We can also call it as an expected return by equity shareholders. What equity shareholders expect from the company is cost for the company. Now let us understand this with an example. We'll go very slow because this is very important. Okay, now suppose for example you have 1 lakh rupees. I'm taking an example of Indian market. Okay, now suppose you have 1 lakh rupees and you want to invest 1 lakh rupees somewhere, and you're asking, sir, where should we invest? I give you two options. Option number one, you invest in government bonds. Now these government bonds are very safe. They are risk free. You don't have any risk in these bonds. Okay, risk free securities are those securities which are the base earning of the market without any risk. That means no fluctuation in the returns. Government bonds are very safe. And suppose for example you are getting a return of risk-free return of 6%. You are getting a risk-free return of 6%. This is option number one. I give you option number two. You invest in stock market. Okay, when I say Indian market, I am talking about either Nifty or Sensex. Say I am talking about Nifty. So you can invest in stock market, and obviously market offers medium risk. There are risk involved in the market obviously, and you are going to get say 6% return over year also. So where you are going to invest? Obviously you will invest in government bonds. If I take risk and I get 6%, it is obvious I will not take risk and earn 6%. So government bonds are very safe. I'll go for that. But if I tell you like this, that I'll be offering you will be getting say 13% return from the market, you will be getting 7% extra. If you invest in market, if you are going to invest in stock market, you will be receiving 13%. But if you are investing in government bond, you are going to get 6%. Then where you are going to invest? Now this depends on your risk taking capacity. If you are ready to take risk, you can go for market. You are taking risk, you are getting higher return. But if you are investing in government bond, assuming that I don't want any risk, then you will get 6%. But both the options are now comparable. This 7% is called as market risk premium, and we can call it as RM, return from the market, minus RF. This is 13 minus 6. Remember the risk free rate, this is called as a market entry point. Now what is market entry point? You are entering in the stock market to earn over and above the risk free rate. Remember, you are not entering the market to earn that risk free rate. That you can easily get it from the government bonds, right? So RF, risk free rate, is the minimum base earning to enter in the market. Now suppose I give you one more option. Suppose you can invest in a company, Indian company, say TCS. You can invest in TCS, and TCS has obviously more risk than the market. Suppose TC has, just a minute, Suppose I tell you TCS is 10% more risky than the market. More risky than the market. 10% more risky than the market. Then how much you're going to expect from TCS? How much you're going to expect from TCS? That is being answered by CAPM. That is being answered by CAPM. So how much you should expect from by investing in TCS? Now for that, let us go to the market. Okay, let us understand this one thing. As far as Indian market Nifty is concerned, there are 50 companies who are there in the which are there in the market. Now this is the list of Nifty companies. See, okay. Now just concentrate on the fourth column. Can you see the market cap column? What is market cap? Number of shares into market price. How do you get market cap? Number of shares into market price. Now there are, see, HUL is the first company, then Nestle, Asian Paints. Like this, there are 50 companies. Can you see? 50 companies. I'll come back to CAPM, but understand this. I want you to understand this so that you can understand the CAPM properly. So that total of the fourth column, market cap total, if that total changes, then the market goes up. For example, Nifty is increased by today, say by 1% or 0.5%. Now what does it mean? Nifty is going up by 1% means what? This total is increasing by 1%. Which total? The total of market cap of 50 companies. Okay, so market goes up and down based on this movement. Now listen. So I'm just writing over here, number of shares into market price. This is called as market cap, and there are many companies in the market, okay. Now for example, say a company named as Reliance, we have a company like TCS, we have HDFC, and like this there are around 50 companies in Nifty. Okay, the total of this 50 companies, total, I repeat, total is say 100 crores. Just an example. Suppose 100 crores. The total of market cap of 50 companies is 100 crores. Say yesterday, this total was 100 crores, and today, this has become 110 crores. Suppose, which means that market has gone up by 10%. 10% in a day is obviously not possible. Just an example. So 10% increase in the market. So yesterday, suppose the Nifty was say 22,000 or say 24,000. Yesterday Nifty was 24,000. Today 10% increase. So that will be 26,000. So 10% is what? 26,400. In short, the Nifty, the market is moving up and down in proportion with this total. Now I come back to CAPM. Listen, suppose if the market is increasing by 10%, does it mean that share price of all the company will increase by 10%? No. If the market is increasing by 10%, some company share may increase by 12%, some of them may increase by 8%, some of them may fall also. Now, which company will increase by how much? That is indicated by beta. That is indicated by beta of the stock. That is indicated by beta of the stock. Say for example, Reliance have a beta of 1.5%, 1.5 times. What does it mean? It means that if market goes up by 10%, share price of Reliance will go up by 15% and vice versa. Say for example, beta of TCS is say 1.1. What does it mean? If market is increasing by 10%, TCS share price will increase by 11% and so on, and vice versa. So every company has its own beta. Say for example, HDFC has a beta of only 0.8. 0.8 means what? If market is increasing by 10%, HDFC Bank share will increase by 8%. If market goes down by 10%, HDFC Bank share will go down by 8%. Now beta of this stock, it depends on the actual past data, and the calculation of beta we are not covering over here. But beta is calculated by using the formula for regression coefficient. formula of regression coefficient, but that we don't need over here. Okay, so beta is the measure of movement in the share price, movement in the share when there is a change in the market. So we can say beta is the responsiveness of the stock to the change in the market. Beta is the responsiveness of the stock to the change in the market. Okay, now can I say higher beta means more share fluctuation? Yes. Higher the beta, more risky the share. Higher the beta, more fluctuation in the share price of that company. Now let us come back to TCS. We were discussing this, right? I said TCS is 10% more risky than the market. That means I have given you beta of TCS as 1.1 and we take the market beta as 1. Like we assume, let this be 100, let this be X. Similarly, let the beta of the market be 1. So market beta is 1. TCS is 10% more risky, so it is 1.1. What does it mean? If market goes up by 10%, TCS will go up by 11% and vice versa. So now, how much you should expect from TCS? So pay attention. Whether it is TCS or whether it is Infosys, whether it is Reliance, whether it is Asian Paints, any company, wherever you invest, risk-free rate is the base. Risk-free rate is the minimum what you want. But because this is 10% more risky, I should get higher premium. What is this risk premium? Risk premium, what does it mean? It's a premium extra you are getting because you are taking risk by investing in the market. Market risk premium, it is the premium extra return which you are getting because you are taking risk by entering in the market. That is called market risk premium. But here in TCS, the risk is higher, so I should get more premium. So now, what should be the company risk premium? TCS is a company and I am investing in a company. So I am talking about the company risk premium. So it is calculated like this: beta RM minus RF. How much is beta for TCS? 1.1. This is 13 RM and RF is 6. So you get total 7.7%. So what is the total return we can expect from TCS? 7.7 plus 6. So 13.7% return you can expect from TCS. So what is the formula now? The formula is expected return from TCS, or I can say cost of equity for the company. It will be equal to RF, that is the minimum I want, risk free rate, plus I want risk premium additional because I'm taking risk by investing in the market. So I want beta RM minus RF. This is the formula for CAPM. Now actually, just a minute. Actually, this is an equation of a line. This is actually an equation of a line. CAPM is an equation of a line. That line is called as SML, security market line. Let us understand this. Pay attention. Now, what we do is on y-axis, we take return of a security, and on x-axis I take the risk of the security and beta. Beta is a measure of systematic risk. Beta is a measure of systematic risk. We have already discussed what is systematic risk, what is unsystematic risk. Unsystematic risk can be measured using variance and systematic risk can be measured using beta. You can refer my earlier video for this particular concept. Now this beta, I need two securities. I need details of two securities to plot a line, right? So let us take two securities. Which are those two securities? I take risk-free security, and I can take the market. Now over here, what is in this example? This is the government bond risk-free security. What is the beta of this particular security? It is 0. So why 0? Market goes up, market goes down, government bonds will not be affected. Will not be affected. So what is the beta of government bonds? 0. Risk-free securities beta is always 0. And for market the beta is 1. What is the return for risk-free security? It is RF. It is RF. And what is the return from the market? Return for the market is RM. Okay. So we take like this. So risk-free security, the beta on the x-axis, beta is 0 and it is RF. And for the market, it is 1 and RM. Okay, and RM. Now, let us plot these two. Let us plot this. 0 and RF will be somewhere over here. 0 and RF. Okay, in our example, it is 0 and 6, correct? It is 6. Risk-free security is 6 return, and market return is 13. So I can just write like this. This is 0 and 6, and this is 1 and 13. So if I plot 0 and 6, it will be somewhere over here. This will be 6 and 1 and 13. So say beta is 1 and 13 return over here somewhere. So this is 1. Yes, beta will be 0.2, 0.4, 0.6, 0.8, something like this, right? So say here it is 1 and here it is 13. So I can just plot over here, say this one, 1 and RM, correct? 1 and RM. So I have plot. I have taken 2 points. One is the risk-free security, it's beta and return. Market is beta and return. This is common for all securities, whether the shares are of TCS or Reliance or Asian Paints or HDFC. Any share you buy, it doesn't make any difference, because risk-free rate is common for everything. It's a common rate in the market, and the market Nifty itself is common, right? So now what we do is I just join these 2 points, and this particular line is called security market line. CAPM formula is the equation of this line, is an equation of this line. CAPM is an equation of this line. Let us understand. Now see, to write an equation of a line, we need slope, right? Slope. Now how do we write slope? How do we calculate slope? Say this is x1, this is y1, this is x2, this is y2. So slope of a line is given by y2 minus y1 upon x2 minus x1, correct? It is the change in the dependent variable upon change in the independent variable. If beta changes, return will change. So return depends on beta. So this is dependent variable and independent variable. Okay. So let us put the values. So what is y2? This is y2, y1, x2, x1. Okay. So y2 is rm minus y1 is rf upon what is x2? x2 is 1 and this is 0. So rm minus rf is the slope of this line. Now how do we present the equation of a line? How do you write equation of a line? Equation of a line is given like this: y is equal to mx plus c. Okay, in that x and y variable will remain in the equation, but what is m? M is the slope of a line. And what is c? C is the constant. We call it as y-intercept. This is y-intercept. Now what is y-intercept? This line cuts the y-axis over here. This particular segment is called as y-intercept. Okay, so over here, what is the y-intercept? This is the y-intercept, RF. This is RF. RF, this is the y coordinate. It's a y coordinate. So over here in our example, it is 6. So RF is the y-intercept for this line. What will be the x-intercept? This will be the x-intercept, but we are not interested. So this line will have an x-intercept over here, right? So what is the y-intercept? This is the y-intercept. So let us make an equation of the line. So y is equal to m. What is the slope? Rm minus Rf into x plus c. What is y-intercept? Rf. So y is the return, on the y-axis the return. Then Rm minus Rf and x is the beta plus Rf. So this is the equation of CAPM. This is the equation of CAPM that we did earlier. So technically this is nothing but an equation of a line. Which line? SML. What is SML? Security market line. Okay. So CAPM helps an investor to estimate the return from a particular stock. Now let's take an example. Test your understanding. Question number 20. The current market, average market return being paid on the risky investment is 12%. So this is RM in our formula. What is the formula? RF plus beta, RM minus RF. That is the formula, right? And 5% on treasury bill. This is the risk-free rate. This company has a beta of 1.2. Then question is, what is the required return on equity? So what return we can expect? The expected return is equal to, it is RF. It is RF. How much is RF? RF plus beta RM minus RF. You can just write down this in your book. RF, it is 5%. Beta is 1.2. RM is 12. And RF is again 5%. So that comes to how much? So 7 into 1.2 plus 5. So that comes to 13.4. So 13.4% is the return which is expected from this company, from G company. Okay. Let's take another example. This one. B company is currently paying a return of 9%. So this is the return which we can expect by investing in the equity of this company. If the return on GILTs is currently, this is gold linked government security. These are also government securities, GILTS. And the average return on market is 10.5 RM. What is the beta of the company and what does this tell us about the volatility of B's return compared to those of the market on an average? Okay. So first of all, let us write down the formula. Write down RF plus beta RM minus RF. Risk-free beta of the stock RM minus RF. Now over here the return is 9%. 9% return. RF is 5.5. Beta is to be calculated, right? RM is 10.5 minus 5.5. So that comes to how much? This is, just solve this. So that will be 9 minus 5.5 and then you divide by 5. That comes to 0.7. You solve this, you will get 0.7. 0.7 is the beta. Now what does this 0.7 indicate? What does this tell us about the volatility of the B's return as compared to those on the market? Now see, if the beta is more than 1, it means that if market is going up by 10%, this particular stock is going up by more than 10%. It is more volatile as compared to the market. If the beta is less than 1, it is less volatile as compared to the market. If beta is 1 for a particular stock, the beta is 1. We know that market beta is also 1. So what does it mean? It means that if market goes up by 10%, then this particular stock also goes up by 10%. So volatility of this stock and the market are exactly same. Okay, there's one more example on this. We'll solve that, this concept, and then we discuss certain assumptions of CAPM. Now let us do this. Risk that cannot be diversified, it is systematic risk. The risk which we can diversify, that is unsystematic risk. Okay, so this question, beta factor measure the systematic risk of a portfolio relative to market portfolio. Which of the above statement is true? Let's see. Beta is less than 1, so less volatile. The security is less sensitive to the systematic risk than the market average. This sentence is true. Why? Because if market goes down by 10%, then this stock will go down by less than 10%. It is less sensitive as compared to the market. Okay. Then if beta is more than 1, the security is less. No. This sentence is false. If beta is more than 1, the security will be more sensitive. So this sentence is not correct. False. The next one. If beta equal to 1, the security exposure to systematic risk exactly matches with the market average. Yes, the sentence is true. Exactly 1. If beta equal to 0, the security is risk free. Correct. We have already discussed this. True. So which of these sentences are true? 1, 3 and 4. So 1, 3 and this is the answer. Okay. Now advantages and disadvantages of CAPM you can go through. That's quite simple. But the assumptions of CAPM, these are the assumptions of CAPM. Assumptions of CAPM, there are 4 assumptions, 1, 2, 3 and 4. Number 1, well diversified investor. This is an assumption that all investors, they diversify their portfolio. If they diversify their portfolio, the unsystematic risk is almost eliminated, and they are interested only in the avoiding of systematic risk. Yes, so unsystematic risk is eliminated and they are interested only in systematic risk. So beta works very well for these investors because beta is a measure of systematic risk. The market movements are measured by beta. Okay, say you have a portfolio, your portfolio return will go up, go down. You want to compare with the market. When the market is up, what will be the effect on the portfolio? If your market is down, what will be the effect on portfolio? That is measured by beta. But this is an assumption that unsystematic risk is eliminated, right? Because of the diversification. Perfect capital market is an assumption which is practically not possible because perfect capital market assumes no taxes, no transaction cost, perfect information that is freely available to all investors, which may not be possible, which may not be sometime possible. All investors will be risk averse. No, some investors, they take risk, they are ready to take risk. Risk averse means what? Investors doesn't want to take risk. So risk averse means some investors may have to take risk, they want to take risk, so all of them may not be risk averse. Large number of buyers and sellers in the market, this is fine, this is okay, but the real world capital markets are clearly not perfect. We cannot have a market where everything is possible, no taxes, no transaction cost. That is not possible. Unrestricted borrowing and lending at risk free rate. See, borrowing and lending at risk free rate practically may not be possible. For an example, investor is taking risk, he may expect more than the risk free rate, he may be not satisfied with the risk free rate. Getting it? So the minimum base level may not be the risk free rate, it can be something less, something more, in fact, not less, more. Okay, borrowing at risk free rate, it is practically not possible. Okay, risk free rate is a very low rate, so you may get the borrowing at that rate, may not be possible. Single period transaction horizon. Now it is assumed that when we are talking about the beta, we assume that if the market goes up by 10%, okay, the return of a particular stock goes up by 12% if the beta is 1.2. So that return, we assume it is for a single period horizon, say 1 year. So all the stocks, we are comparing the return of all the stocks for say 1 year. Okay, so return is same for all the stocks. Return period, I'm saying. Okay, and there are some advantages and disadvantages of CAPM which are actually very easy for you to understand. You can just go through this, nothing much to be explained in this. So this is all about CAPM. Hope you liked the video, and if you want to just subscribe to my channel, and if you are interested in buying the lectures, my sessions, then you can log into the website Let's Learn, and you can call up on 844-844-8919 for the lectures. Happy studying. Thank you.